love to just start out here, just kind of introducing yourself, talking us through some of the stuff you do and who you are.
Sure. I'm an engineer by training, master's in electrical engineering, worked at Digital Equipment Corporation back in the 1980s, started investing in college with my then girlfriend, wife now, when we were both broke, and decided, hey, this investing thing, I might be good at it. And was a sell side analyst for a decade, first at Robertson Stevens, then at Lehman Brothers, and then I've been running my hedge fund now since 2004. So, and obviously my specialty is tech, but I invest across the markets. And yeah, that's the quick bio on Dan Niles.
Awesome. We really do appreciate that, and we're lucky to have you on. So I really do kind of just want to jump right into it. I was looking on your website before. One of your most recent articles, I pinned a couple of the charts up in the nest above for anyone who wants to follow along as we're talking here. But I would love to kind of start out from on the macro perspective here and the macro front. I think that's a very important way to kick us off here. Maybe we can work our way down. Love to know how you're feeling about the market on the macro front, the Fed, bank crisis, all that stuff.
Sure. I mean, I think maybe just setting the table, where we are today really started back in 2007, 2008. And I can see where you pinned the slide. So if you go, if your viewers or listeners, I should say, click onto those slides and go to danniles.com, they'll see some charts because I'm a big believer pictures are worth 1,000 words. But back in that 07, 08 period, you had a ton of bank failures, and it just accelerated as time went on. You had 25 failures in 08, and then after you passed TARP, the $700 billion troubled asset relief program to kind of help the banks out, that bank failures went from 25 to 140 in 09, and then went back up to 157 bank failures in 2010. And so the upshot of that is tons of balance sheet expansion by the Fed. And then with COVID, you kind of supercharged that. And so if you go to the second slide in that post that you put out, you'll see the correlation between the Fed balance sheet, which was 900 billion before Lehman failed, to where it was at the peak of COVID, which is 9 trillion. So up 10x from the lows of 900 billion. And every time the Fed has tried to wean you off of that, the stock market has had a temper tantrum. 2011, 2015, 18, even 2020, and then obviously recently in 2022 with the peak there. And the upshot is you can stimulate, hand out tons of stimulus checks, do all of that if there's no inflation. Because inflation, the problem is for that percentage of the population that doesn't own stocks, and so that's about 45% of the population, and that doesn't own a home, and that's about 35% of the population. For those people, they don't get the benefits of asset inflation with your stocks going up, et cetera, or your home prices going up. They're just getting killed when they go to the grocery store, have to fill up their car, pay their rent. And so when you have inflation, you got a problem, and then the easy money has to stop. And that's unfortunately where we are today. And a lot of the things that made inflation stay low, so you could go ahead and hand out all of that easy money, has reversed. So China had their population decline for the first time in 60 years. It really started with their one-child policy. So all that cheap labor in Asia, that's going away. Used to have cheap energy. Then we moved to the worst expansion after a recession in history over the last decade following 08, 09. So you had very little money being spent on expanding, copper capacity, oil capacity, et cetera, by those companies. And then you throw on top of that all the green policies, they really don't want to invest. So cheap energy is now not going to be probably so cheap anymore going forward. And then the final piece of it is onshoring, right? Because you go back and it's, well, let me throw out manufacturing to China, other regions around the globe where it's easier and cheaper to build these things. And now you're going, well, China's not my friend anymore. They may invade Taiwan. You know what? Maybe we should put up fabs in Arizona, which is great. But the problem is those fabs all in are probably 5 times more expensive than they are sitting in China, Taiwan. And so those trends are just mega trends that have been going on for decades that now are reversing. And so where I'm getting to this is not talking about tomorrow or next year, but over the course of the next 5 years, multiple years going forward, that makes it a lot tougher box for the Fed to step in and save you if there is another problem. And obviously, as we've seen with the three of the four biggest bank failures in history that have just recently happened, we do have some problems we have to deal with. And so that's kind of the backdrop under which I'm operating. And none of this would matter if valuations were cheap. But if you go to the third slide, just a quick summary is you're at about 19 to 20 times PE on the S&P 500. When inflation is high, and you look back over the last 70 years when you've had CPI above 3%, the trailing PE is generally about 15 times. You're at about 19 to 20 times today. So you don't even have valuation support. And so if you have a problem with earnings, et cetera, like you're seeing with Disney today, right, where obviously numbers are coming down. They had a rough quarter and the stock's down, 9% in a day. There's really no valuation support and you're just going to get absolutely killed. And so that's kind of the backdrop right now where it's culminating in earnings estimates going down as lending standards tighten because of the banks. Multiples are still high, which don't discount the risks. And you probably have inflation on a structural basis being higher than it was historically.
Awesome stuff, Dan. We appreciate your comments. First of all, fantastic to have you. We appreciate you coming up here and joining us. It's been excellent to get to talk to you. So I do have a few specific questions for you, Dan, and then we'll throw it over to a panel. I know we have a great panel here as well that has a number of excellent questions. But one of the signatures, if you will, of your fund is risk management. We were actually touching on that before you joined in. You were one of, a lot of people don't know this, but out of the tech-focused funds, you were one of the very few last year that managed to navigate to profitability. I was wondering if you would talk just a little bit with the audience about the kind of strategies you guys employ, the way you function, your risk metrics, and just briefly, I mean, it doesn't have to be a tremendously detailed outlook, but on the way you guys have been so successful in doing that, despite being a tech-focused fund, seeing as so many of the tech-focused funds have struggled with that in climates like this.
Sure. I think that the thing people forget is risk management is really important. Because if you're down 100%, you can be up 10,000% and you're still at zero. So, or look at it differently. If you lose 50% of your money and then you gain 50%, you're not back to even, right? You've still lost 25% of your money. You got to be up 100 to get back to even. So, for us, trying to protect the downside is, very important. And I think tied to that is I think the smarter people, the longer they do this, I've got 22-year-old sons, right? And I was, talking to one of them the other day, and I was going, look, you think you're really smart now. And I know when I was 22, I felt a lot smarter. Now that I'm in my 50s, I realize how stupid I actually am because you realize that the world changes in ways that you would have never, ever imagined. And, and so to think, and I see this with some portfolio managers where I go, they should really know better because they should have the wisdom of experience is, I remember when I worked at Digital Equipment Corporation, my first real job, it was the Google of its day. It was, the king. It had displaced IBM. And you're like, wow, this company is amazing. And then they made the decision, well, nobody's going to want a computer on their desk. And then this little company called Dell showed up and it's like, well, maybe people do want a computer on their desk. And then obviously you fast forward from there and, that kind of switched from the way to get onto the internet to this thing called a smartphone. And even if you look at the smartphone industry, Nokia had 40% market share. And then Motorola came around with their flip phones and Razr. And then there was this company called BlackBerry, and you may remember it was called the Crackberry at one point because it was so addictive. And then this guy pulls an iPhone out of his pocket in 2007, and it switches again. And you can go through that with, social media where it was MySpace, Facebook, and now you got TikTok. Obviously, you can look at search even. Same sort of situation, right? You guys probably remember Yahoo. Before that, you've got Alta Vista, and a whole bunch of other search engines. Sure keeps shifting, and now you got this company called Google. So I think going, oh, I don't care, it's going to be $1 trillion from now and I'll buy it and I don't care about the valuation, if you've been doing this long enough, you should realize how fallible you are. And quite honestly, some of the big names that exist today, right? You look at Cisco, the stock got up on a split adjusted basis up to, I want to say like 70, 80 back in its peak in 2000. The stock's at 46 today. The revenues are way higher than they were in 2000, multiples higher. You look at a Sienna, similar situation, right? The stock is even more egregious where the stock got up to like 1,000 and the stock's at 44 today. And you look at Akamai, same situation, right? They deliver content for the internet, right? That's a pretty good business back in 1999, but the stock's gone from 300 to today it's at like 85 or so. So valuation's really important. And a lot of the stuff I see in the media, people don't talk about it. And so we focus a lot on the valuation piece as well, because I like a margin of safety. Because I know with all the shifts I've seen in the technology industry, from winners becoming losers, etc., that you could be wrong. And if you are, you want to make sure you're not overpaying for it and you just get wiped out and you can't recover. So I think that risk management piece is part of it. And kind of tied to that is you want to not fall in love with your stocks, because that's just the kiss of death, because the stock's not going to love you back, right? People look at Apple today and they go, oh my God, it's just, unassailable. And they come up with all these wonderful reasons. And some of those people don't remember the fact that Microsoft had to buy 25% of the company to keep them from going bankrupt. And this is the company that invented the PC industry, arguably. So I think you kind of have to realize that things do shift, and a great product is not the same as a great stock. And those are two very different things. So that's what we try to manage, is manage your risk well, try not to lose money, try to be humble about knowing what you don't know and how things can really shift. Chat GPT, AI, I'm sure we'll talk about it at some point, right? Like that's a big shift that's going on right now. And then don't fall in love with your stocks, be agnostic and pay attention to valuation. And that's how, we were up last year and we're up again this year. And obviously very different environment this year than last.
Yeah, we certainly will get to the AI topic for sure, Dan. But one thing I want to chat briefly about, or just touch on and get an update from you, is your short exposure. So last time we talked, or last time I guess I heard you speak, and I don't know if it was your most recent appearance, but it was on CNBC about a month ago. You talked briefly about how you guys, opened the year with 55% exposure, but you guys covered those shorts, headed into the rally, and you guys were down to about 5%, I believe. And you said you'd begun ramping that back up, and that you were nearing the 25% mark, but you were nowhere near your peak. Where's your short exposure at now, and what's your overhead view on equities in the second half of the year? Is there a rationalization for that?
Yeah, we actually now have more shorts than we have longs. So we've continued to ramp that up. It's somewhere between 40 to 50% of the portfolio at this point, because I kind of look at where the market is and go, estimates are still going lower. And for those viewers who just sort of look at Apple and the fact that it was up the day they reported earnings, I go, yeah, that's great. It was up. But the estimates for June went down. The revenues went down 3%. The earnings went down 2 to 3% or so as well. And it just so happened to be up, which is great if you own it. But you're also buying it at a 28 PE. And to put it in perspective, the S&P 500 trades at a 19 PE. Their revenues were down year over year. Their earnings were flat year over year. And to me, I go, there's no margin of safety in owning that. So for us, as we've seen the market hang in, and obviously today PacWest, on the banking side, got hammered for another 23%. There's still a lot of stress in the banking system. And we haven't even started to deal with the stress in commercial real estate, which is going to start to really come to a head later this year as a lot of those companies have to refinance. Because if you think of commercial real estate, you created a ton of commercial real estate when COVID hit, because that commercial real estate was called your home office. And now with people doing hybrid work weeks, property values in the commercial real estate space are just going to absolutely get pummeled. So for us, credit is the lifeblood of the economy, and that's getting choked off as these banks are trying to keep from going to zero. And so their lending standards are going way up and tightening. And people forget this is a process. It takes time. If you go back to 2000, March of 2000 is when NASDAQ peaked. It took you till October of 2002, so a year, 2.5 years later, for the NASDAQ to actually hit bottom. And it went down almost 80% over 2.5 years. But you had these fantastic rallies in between, which people forget. And each one of those rallies, people think it's the bottom, and then they get worked over. And, and that's true no matter what time period you want to look at it. Great Depression, the tech, the global financial crisis, same thing. I mean, you had 5 rallies between the global financial crisis and the tech bubble. 5 rallies on average on the S&P between 18 to 21%, while you lost, I think it was like 49 to 57% of your money. Right now, remember the long-term average for the S&P is about 8% a year. So to get 20% over a short period of time, like, that's phenomenal. And you still got killed because the declines were way worse. And we're human beings, right? You always want to believe tomorrow is going to be better than the day before, etc. And it's a 3-month problem, and things will be good. And right now, that's, I look at this and I go, I mean, Disney's a great example of that. They lost subscribers in the US. The advertising market was horrific. They even talked about the parks business, going forward, maybe not being quite as strong. And, one of the themes we've picked up is China is reopening, but that reopening is not as strong as what we thought it would be. Second biggest economy in the world. And all of those things, they matter. They don't matter today, not tomorrow, but over a longer period of time. Those are all things you need to work into your calculus. And so the market being up here, that's why our short exposure has ramped back up to the point where we have more shorts right now than we have longs in the portfolio, and we're sitting on a little bit of cash. And I think that's important, right? Last year we had longs, and we lost money on those longs. I mean, we had some good ones, to be fair, right? We had some stuff in energy, etc. But in general, we lost money. It was our shorts that enabled us to be up for the year, because we did a very good job managing those and making sure that, okay, we might like this name, but if there's a problem and it comes down, then this one's going to have an even bigger issue. And that enabled us to work. So I think shorting it's dangerous. Like, I don't recommend it for retail. If you were to do a single stock short, unless they really know the name well, because you have to worry about, getting acquired or something, right? Obviously, you don't need to worry about that if you're short an Apple or Google or something big cap. But we tend to use a lot of index shorts on the S&P 500 or on the NASDAQ to avoid some of that. And we tend to manage our shorts very, very aggressively, as you rightly pointed out, how, we went from, coming in over 50% short, took it down to less than 5, and now we're back up to, the 40 to 50 range now again. And, we tend to do that based on our views on the fundamentals, as well as views on valuation and where the economy is, et cetera.
Dan, we are getting a little bit of feedback in between. I think if you move the mic just a touch away from your mouth, I think that should be fixed.
Oh, I'm sorry. Is that better?
No worries. Perfect. That is perfect.
Okay.
But yeah, I just kind of want to jump in on, you kind of touched it there. The market has been very different last year versus this year, and obviously you have seen a lot. 2000s tech bubble, 28 financial crisis, and a lot. I would love to know kind of what this market really reminds you of, and how you're playing it based on the past, and if it's really different, kind of what makes it very different than the past.
Sure. I think, that's a fantastic question, Evan. For me, it reminds me most of 2000. And the reason I say that is because in 2000, you had a 10-year expansion. It was absolutely wonderful. And, multiples in that tail end of 2000 just went vertical. And what people forget is there was this whole Y2K issue where people thought, well, we're going to get to the year 2000. A lot of computers aren't set up to handle when it goes from 99 to 00 because a lot of computers didn't have like 4 digits, they had 2. And so the Fed pumped in a lot of money into the markets in 1999 just in case. And then we got to January 1st of 2000, the world didn't end, and then they started taking out that stimulus. And the market peaked because people had spent so much money in front of that, and then demand fell off, multiples were high, and then, as I said, we went through 2.5 years of punishment. The S&P was down 3 years in a row, right? 3 years. So to me, that's why this has a lot of similarities, because we've really gone through an uninterrupted expansion from really 2008, when you had the Lehman failures, etc. Tons of money coming in, lots of stimulus, and then you got that final burst, just like you had in 1999 with the Y2K fears. You had that final burst of stimulus off of COVID, and now you're trying to have to unwind that. And quite honestly, unless you've been doing this for 20 years plus, you have no experience dealing with an environment where you're not getting saved every time there's a problem. And so that's why I think that period of time, to me at least, because I've been on Wall Street since 1990, seems most familiar to me. And the other period, which I obviously didn't live through, but I'm a big believer in that Mark Twain quote: "History may not repeat itself, but often does rhyme." If you look at the 1970s to 80s, and I've spent a lot of time on this, and for people who are on my website, danniles.com, there's a lot of charts that actually go through what it looked like in the 1970s. You went through this series of, you had inflation, the Fed stopped or cut, then inflation came back, they had to raise again, then they stopped or cut, and then it came back a third time, and then Paul Volcker finally killed it. But it was a decade-long fight, and stocks went sideways, obviously with very volatile ranges for about a decade. And so, obviously, given the high inflation period we are in today, there's some similarities to that as well. And
And you touched briefly. You touched earlier on how your short exposure had gone up, and the reasons for why. And you mentioned there's still longs that you guys have, and longs that you've liked. I know in the past you've mentioned 2 names specifically that I would just love to get a quick update on where your perspective is today on those names. I know Meta, you had great timing there, and you were buying in the 90s, and you guys caught that face ripper rally in Meta. And I know you also at one point mentioned your guys' position and your view on Intel as well, and that was a top 5 pick for you at one time as well. So, what are your quick thoughts on those names, where they are today? And then from there, we're going to jump straight to Monative, who I know has some great questions for you as well.
Sure. We still love Meta, and because I think, back to the valuation piece of it, Meta trades at about a market multiple. So, and that's great, and their business is starting to accelerate. They beat the quarter, revenues, EPS, and the numbers went up. That's very different than a company like Apple, where you're paying close to a 30 multiple and the numbers went down. And if you think about Meta, the reason we were buying it in the 90s was, they were planning on spending a lot of money, stock got killed, and we're like, well, yeah, they can turn around and say they're not going to spend that money. And that's exactly what they did. The other reason, more fundamentally, is their TikTok competitive product, which is Reels, was doing very well. Obviously, the pressure on TikTok has ramped up even more, so that's a positive for them. And then they got hurt a lot by Apple's changes on their privacy policies, and now they've lapped that. A lot of the AI related tools that they have to help advertisers monetize better, that's working great as well. And so we like Meta a lot. And with regards to Intel, I mean, Intel's an interesting one because they made the decision about 8 years ago or so, I think 7 or 8 years ago, not to go to photolithography, which is a fancy way of saying, you're spending 250 million bucks for a piece of equipment to make chips smaller. They didn't want to spend 250 million bucks for each piece of equipment, so they tried to use, interesting other metals like cobalt and do all these things to get around it. And what happened is they lost their technology lead. And then they had a new CEO come in, Pat Gelsinger, and he said, look, that was really a bad decision. We're all in on EUV. Now it's 2 years later. They seem to be stabilizing their market share losses, at least on the mobile desktop side. They've been losing share to AMD for 5 years now or so. That seems to be getting closer to stabilization. They're probably going to still lose share on servers until next year when they get their latest versions out on the newest technology. But the linchpin to this, for me at least, is, well, yeah, but there's still risk, right? Obviously, demand for cloud computing capacity has come down a bit, right? Azure wasn't good. Amazon Web Services wasn't good. If you look at how much the growth rate has decelerated over the past year, Google Cloud, et cetera. And Amazon's the biggest, right? And that's the biggest problem when you look at it. But if you look at Intel's valuation, which for me says, well, am I getting compensated for being too early? It's trading at a price to book value of about 1.2 times. And to put that in perspective, if you look at a commodity memory company, and so, using Micron as a good example, Micron has negative gross margins. Negative gross margins. They're trading at 1.4 times price to book. So for me, I go, I'm really getting compensated for buying that. And as you brought up in an earlier question, I have shorts. And so there's other names that I look at and I say, you know what, I think analog mixed signal, it'll be the last shoe to drop. We've already seen a correction in inventory in PCs and smartphone related semiconductors. We're going to see it next in industrial and probably auto later this year, and that's more in the mixed signal analog space. So I can own Intel while I'm short names in that area to try to hedge it out. And for a company like Meta, because I didn't talk about the hedges there, obviously Meta is an advertising model. So in a tough recession, advertising spending goes down. Obviously, you're seeing that in Disney's results, right? Their advertising business was horrible. And so there are obviously traditional media companies we can use to hedge that risk, where we can say, you know what, I think so-and-so is going to have a problem. Their ratings are dropping. People are, subscribers are leaving and the valuation's high. I can short that against Meta. And so if I do end up in a deep, dark recession, which I think there's a very good possibility that happens, hopefully my shorts will once again outperform relative to my longs, and I can match that up.
Awesome. Before we do throw it over to Monative, I do just want to remind people, first of all, make sure you're following Dan's Twitter account. He's sharing out a bunch of tweets, and we're getting a lot of value from him on here. And you can get that for yourself by following him on Twitter. And then also, he's posting a lot of stuff to his website, which is pinned up in the nest above, danniles.com. And you can find a lot of really interesting information and informative information as well. So we definitely appreciate you joining in, Dan, and definitely would recommend everyone go and check out some more of the stuff that you are doing. But yeah, with that, Monative, you are kind of the reason we are here. We definitely appreciate you for sparking this, and we'd love to know if you have any questions.
Dan, been a big fan of yours since Robbie Stevens' days. My wife was at Stanford Business School, and she actually worked with Mike McCaffrey there. So been a big fan of yours since then.
Oh, yes. So, going back all the way back, yes.
Yeah, very long time back. But I will stick to your wheelhouse primarily at Satori is large cap tech. And I have a question about Microsoft and on a related one about Avago. So Microsoft has run up 26%, since the announcement of ChatGPT and their integrations, while the broader tech has run up 9% in Nasdaq and 3.5% in S&P. How much of any near-term future prospects from AI is already priced into the stock? That's my first question. The second question, still about Microsoft, but about ATVI. It's a $70 billion acquisition. Last quarter results in gaming was pretty bad for Microsoft. Is it a good thing if the deal gets killed, or is it a good thing if the deal gets closed? And talking about deals, I have the same exact question with Avago and VMware. Avago is really good at buying, mature businesses and optimizing the cash flow, and they've done that very well. Again, how much of a deep, well are they going to dig themselves in with that? Even though that's a part stock acquisition, it's still a significant lock of their cash.
Sure. So let me start with Microsoft first, and I'll get to Avago. So Bill Gates has this great saying, which given we're talking about Microsoft, it's appropriate to mention, where he goes, technology is often overhyped short term, but it's underhyped long term. So I know there's a lot of hype about generative AI, just like there was a lot of hype about Bitcoin and then NFTs and the metaverse. And I'm sure I'm missing a few, but you get the idea. Now, I believe generative AI is a totally different animal, that it will change everything. But to your point, which I think is a really good one, Monativ, is that you can go back to 2000 and go, the internet changed everything. It still didn't stop NASDAQ from going down 78% over 2.5 years. So I think you bring up a very good point, and this is tied back to what I said earlier about valuations. Microsoft, for me, I'm kind of torn on it, and this is the reason why, is they obviously are in the PC space. And if you look at that, we went through this huge burst of buying during COVID as we're all at home outfitting our home offices and getting computers for our kids who are now home from college or having to learn remotely. And then that demand has fallen off a cliff, as you'd expect, following that. And so PC demand was down close to 30% year over year in the first quarter, and Microsoft obviously felt that. And so that should pick up, even if this generative AI, I do not believe that they're going to gain much share at all from Google. Because at the end of the day, these models all function on, you train them with as much data as possible. And Google, just by the fact that they're 90% share in search, has more data than probably anybody on the planet, by far, certainly more than Bing has. And so they can train these models, and I think Google will do just fine. The one problem is that it's, for Google, is that it's more expensive, right? Because you return a search result, and I know these numbers are coming down, but the chairman of Google was like, I think at one point he said it was like 10 times more expensive or 5 times more expensive, and obviously that'll come down. But the margins for Google are going to just be sort of under pressure. And for Microsoft, it's all incremental revenues. But, I just do worry that people probably not going to happen. They did definitely a better product demo than the first one that Google did. Obviously, Google had one 2 days ago, and that went great. But that's why I worry about, those are the two conflicting things with Microsoft. Lots of hype, but the good news is the PC market should be improving, which is also why we bought Intel. But you're not, unlike with Intel, you're certainly not getting any bargain buying Microsoft. With regards to ATVI and the deal, I think from a long-term perspective, like getting gaming, things that make people sticky, like I've got got some 20-something-year-old kids. They love gaming. A lot of people started gaming over the pandemic, and they've sort of kept that up as a way to stay connected with your friends all over the world. And so I think it's good for them long term. I wouldn't like the deal to get broken, but I'm not sure it's really honestly going to matter for the stock that much. I would normally think of it as a slight negative, but I know Microsoft keeps saying they're going to close it. I don't think most people think it's going to get closed. So I'm not sure it's going to be that impactful. But from a long term perspective, yes, I think it would be good for Microsoft to be very sticky set of customers, because gaming at the end of the day, like, I don't get it. Sorry, I shouldn't say I don't get it. But for me, my sons went to the League of Legends World Championships in San Francisco. For me, I've gone to the Super Bowl and the NBA Finals. But, it changes, right? And for the new generation of kids, gaming's a big deal. You can get scholarships to go to college on gaming. And so I think that's a good thing going forward. With the Vago, I love Hawk Tan. I think he's a brilliant CEO. I took his first company public, ICST, when I was on the sell side. So nothing but praise for him. The issue I have right now, and it's more of a philosophical one, is when things get tighter, the better companies win. And as you said earlier, he's buying a lot of legacy companies in software that other software companies, quite honestly, looked at, and even though they have businesses that are similar, didn't want to buy. And so if you go into a tougher economy, I just wonder how well those businesses are going to do. And that's more of a philosophical point, and one I'm still sort of thinking about. The good news is, though, with Avago's stock, you're paying about 15 times, and as I said earlier, the S&P is around 19, 20 times. And so it's not that expensive a name. From a fundamental basis, if you're thinking about excluding VMware for a second, the thing you have to be concerned about is they're in the mixed signal analog space, and do they see some impact from that space starting to slow down later? Because you've already gone through the damage in the PC smartphone space, and does that just sort of ratchet through to other sectors? And so that's kind of my thoughts around that. So hopefully I've answered your questions.
Thanks, Dan.
Awesome. We love that. I'd love to throw it over to Mr. J, Special Sits.
Hey, how are you? Dan, I think one of the biggest compliments, you can pay a tech investor after the carnage we've seen since the fourth quarter of 2021 is good risk management. And I wanted to,
That's true, and you survived to tell the tale and made some money.
exactly. And we were short, SPACs in a really huge way starting in the summer of 2021.
Good
A
for
lot of
you.
those companies are now trading below cash. And there are companies that are trading at 50% of cash, some of them rightfully so because they're burning. Some of them are acquisition candidates or likely be liquidated. What are some themes outside of unprofitable tech that you find interesting to set up short positions, and what drove you to ramp up your short positioning back to 40% from 5% earlier in the year?
So I think what you see, okay, so just kind of going through it. Yeah, I think stocks trading below cash. I mean, I'm looking at some right now and trying to think about, all right, is this a melting ice cube? Because a lot of them are. They're just value traps, or is this something where it's worth looking at? And people may forget, but Apple back in I want to say like 2001 or '02, they were actually trading below cash on the balance sheet at one point.
They were. That's when Icon, that was actually pre-Icon Icon getting
Yeah.
involved. But yeah,
Yeah, I mean,
you're
so so stocks always go lower than I ever imagined humanly possible, and they always go higher, like with GameStop, than I ever imagined humanly possible. And so that's just something you sort of you kind of live with, but then you kind of have to figure out, is there an opportunity here? With where I'm putting my shorts on now, part of the reason is that it's been a very uneven earnings season. Some companies have done well, others have done poorly, and they're the same exact space. You can look at or it's when they report it, right? One guy reports first, it's not so bad. The next guy reports, like Amazon, and Amazon Web Services is absolutely, much worse relative to Google Play or Azure. And so that stock gets hit a lot harder. And by the way, we picked up Amazon after that hit on earnings, and we can talk about that if you want. But to your question specifically, the thing I'm noticing right now is a lot of cloud consumption based software stocks. So guys whose business models are based on, well, how many employees do you have? I'm going to sell you a seat to that. How much consumption are you doing of public cloud? A lot of those names, some of them have put up some pretty solid results. And I sort of sit there and I scratch my head and go, okay, Amazon's 50% roughly of the public cloud market, and their revenues went from 20% growth in the fourth quarter to 16% growth in the March quarter to they were tracking to 11% growth in April. That's pretty big deceleration. And so the one thing I've learned, having done this for a long time, is you sort of sit there and you scratch your head going, well, how does this guy who's the biggest in the space sound like this? And this other guy is telling me there's no problem. And what I've learned over time is typically it's just a timing issue. One guy's seeing it first, the other guy is able to, as I call it, pull cookies out of the cookie jar, right? Where they're small enough where they can drive their salespeople to close that last deal. And pretty much and you've probably heard this on conference calls too, because obviously you're listening to them. You hear a lot of companies say, well, 6 months from now, we think the economy will reaccelerate.
And based on what? Exactly.
Well,
it drives me
exactly.
nuts.
Yeah,
It drives me nuts.
and I go, okay, so that's your forecast for the year, and I'm sitting there going, well, all the tightening in the pipeline from 500 billion in assets in 3 different banks going to zero, that's having a impact that you're going to feel by the end of the year. So by the end of the year, I think we're going to be in a recession. Maybe by some miracle we avoid it, but even the Fed's own forecasters, and granted their forecasters have been horrific, they think that we're going to be in a small recession. And they've been optimistic this whole way through. So for me, I'm looking at the names in software that are in there where the stocks have rallied hard off of results, and where I go, well, either Amazon Web Services is really going to accelerate from here, in which case I'm going to get paid off in having bought Amazon. And quite honestly, I bought Amazon despite that. I bought it for their retail business.
Yep.
And I was like, all right, I can hedge some of that by putting on shorts in the other companies that are related.
Wayfair and other companies. Yep.
Not so much that's more commerce, but the software specific names. And I'd rather not get into which ones specifically, but there have been a few of them, and I'm sure you can guess which ones that have ripped and gone straight up off of
saw
earnings.
One yesterday that went parabolic.
Yes, and so and I have started putting my shorts back on in those names where I tried. For me, a lot of times, if a stock's gone pummeled into earnings, I cover my shorts or I cut them way, way back. And then, because I know if you get a short covering rally, you're going to get your face ripped off. And so I'd rather go after it after it's up 20, 25%, 30%. And everybody's excited because they said AI on the call like 50 times. And so they think it's somehow immune. That's when I get really interested. The other thing, too, is some of these companies have big government contracts. And
exactly. Yep, I know what you're talking about.
You're going into a debt ceiling fight. Now, maybe it's going to be different this time, but the last couple of times, and this is not the first time we've been in a debt ceiling fight, when you've gotten into that, the government tries to shut off and save as much cash as they can. To me, that's a risk. So we'll see what happens, but that's how we're trying to hedge out some of this stuff because, you go into a recession, you're ordering on Amazon's retail business is going to slow down too. And, your point on Wayfair is well taken because, their results on the retail business looked a lot different than Amazon's. And, again, back to the dichotomy, right? Like Amazon's retail business was better. Their AWS was the problem. We'll see how this shakes out because in general, you've seen a lot of the smaller companies have much different results than some of the bigger ones, and we'll see how that plays out with time. But I think that's a good
Just a
use.
quick follow up, because you said a lot of really good. You made a lot of really good points. It'll be efficient. Number one, how do you define this Wall Street culture of continuously putting out these hockey stick forecasts? Is it just the analysts are very junior who are left on the street, or is it just the compensation issue where they don't want to put out too many sell ratings, or is management just so uncertain that they don't have any concept of what the consumer is going through, what the banking system is going through? And then the second part of the question is, you talked about web services, and I agree with a lot of the points you made with the three companies in that space. What do you think about, Apple and how Samsung missed, Qualcomm missed, a number of the suppliers have been missing, yet, the hardware revenue was down 3%, and management thinks that, it's going to be the same next quarter while everyone else is contracting in their supply chain.
So I think with forecasts, basically it's survivability, right? You've been paid to be optimistic for the last 13 years, so the only guys that have really survived have been the eternal optimists. I mean, think about it this way, right? If you had a perfect crystal ball and somebody had come and said, by the way, we're going to have a global pandemic that's going to shut down the entire planet, your first thought wouldn't have been, oh, let me run out and buy stocks. But that's exactly what you should have done, right? Because in 2020, the S&P was up 16%. I think if I remember that correctly.
Yep.
In the middle of a global pandemic. Like, on what planet does that make sense? But if you were somehow an optimist and you're like, yeah, the Fed's going to dump in all this money and the multiples are going to go skyrocketing and you're going to be the moon, and you pick whatever. Metaverse is going to be unbelievable, and Facebook changes their name to Meta even. As irrational as that might sound, that's what was good. And so the people that are sort of left and who've gotten a lot of airtime, whether it's fund managers or sell side people, are the optimists. And by the way, that's been going on for 13 years, right? Because the multiples have just kept expanding. And I mean, just backing up a little bit, if you go to 2021, I think Amazon and Netflix missed 2 or 3 out of the 4 quarters in 2021. Both stocks were up in 2021 because you had all of that stimulus. And I think that's why you've gotten where you are today, because it's paid you over the last 13 years to be an eternal optimist. So that's why I think forecasts are where they are. And management teams similarly, right? If you made a mistake, that was okay because you were going to get cheaper money tomorrow. And rates eventually went to zero, and they stayed at zero. And so you were able to borrow money to get yourself out of the mess you got yourself into. And a lot of the management teams, if they've never been through a hard recession, remember, you would have had to have been a CEO on Wall Street for at least 13 years. Well, actually, let's see, Lehman failed in 2008, so actually longer than that. 15 years, I guess, at this point. To have lived through an honest to God real recession. That's a long time. There's not a lot of CEOs out there. There's not a lot of money managers that were managing money back then either. So I think that's just sort of survivability bias. With regards to Apple, the thing I would say is that Apple Web Services, the services division missed when they reported. It only grew, I want to say 5.5% or so. They guided to the same type of growth in the next quarter. The reason the numbers were fine is that iPhone obviously did well, but again, well's all relative because the numbers, had been lowered and expectations were lower, etc. But if you kind of just look at it, just organically, I mean, revenues were down 3% year over year, and earnings were flat year over year. And if you look at next quarter, both are expected to be lower than where they were before they reported. So this whole thesis of Apple's a consumer staple I think is completely false, because you go back to 2019 and I would argue, you know what, the iPhone was in, or your smartphone, whatever you want to call it, whether it's an Apple or Samsung, whatever, it doesn't really matter. In 2019, it was indispensable as well. And for fiscal year 2019, before COVID hit, Apple revenues were down 2% year over year. Smartphone sales globally for the entire industry were down 4 years in a row, because we all have one. And then revenues went from down 2% fiscal 2019 to up 33 in 21, as we are all upgrading our smartphones and our Macs and everything so we can work from home, our kids can learn from home. And now that revenue growth has gone from up 36% year over year to down 3. And the multiple for those who own the stock has been great. It's continued to expand. But at a certain point, that risk reward is getting really ugly. And I think as we go into a recession, people look at a lot of the services and things that they bought during the pandemic, whether it's Disney Plus, which we saw it in the Disney Plus numbers, or whatever you want to say. They're going to start weaning their expense structures, and that's going to impact the services, which is why the services disappointed when they reported, and which is why it disappointed when they guided. And an iPhone services is not the same as food, toothpaste, or toilet paper. And we saw it before, and I think people are trying to convince themselves that it's different this time. And because it's the biggest component of the S&P 500, part of this is a portfolio manager, and this
Flows.
yeah. It's flows, but it's also the easiest thing is to say I'm going to be market weight Apple because I don't want the stock to kill me and my benchmark performance. I may not understand it, but I don't want to get fired, so I'm a closet indexer. And there's a lot of that happens, I hate to say. But when it breaks, then it's going to be head for the exits. And I think this fourth quarter, and we haven't gotten into this, but all that excess money from COVID, there's about $2.5 trillion at its peak of excess savings on consumer balance sheets because of all the stimulus checks that went out. Today, that number is closer to $1.5 trillion. By the end of the year, that number will be down to basically zero. And you're going to go into Christmas. I think the economy's in a recession. In that environment, we'll see how many people rush out to upgrade to the latest and greatest iPhone. They weren't upgrading for 4 years in a row, in the sense that sales were down for 4 years in a row for the entire smartphone industry. I don't remember exactly with Apple, but I know their revenues, I think over a 4-year period in their iPhone division, were down, I want to say 10%. I'm doing this out of memory, so I might be wrong a little bit, but I know I've written about this. It's on my website. And the services piece was doing well, but I do think people are going to get a lot more. Is a little bit tougher. And at this multiple, you're not getting paid to take the risk, in my opinion.
I completely agree with that. And, just logically, if you think about how much the prices of these phones have increased, and the new models are almost the same as the prior model, if you're a family of 5 and you're at the medium income line, right, instead of replacing your phone every 1 to 2 years, imagine if, 30% of their users decided to wait an extra 1 or 2 years to swap their phone. I mean, that's enough to make a dent. And a lot of companies aren't able to raise prices anymore. You look across the consumer space, a very obvious one is grilling, where I've seen, you walk into Home Depot, you see prices for grills down 20% year over year. And other areas are laptops. Consumer laptop sales during this back to school season, we're down like 40%. For the Mac sales, we're down 40%. And across the laptop space, 30%. So, I don't know how long that this charade can really last.
Well, the thing is that, funnily enough, it hasn't been lasting from a earnings perspective. Because as I said, right, Apple's revenues are down year over year. Their EPS is flat next quarter. Both revenues and EPS are now guided to down, or I shouldn't say guided because I just talked to analysts offline. But the numbers go
right. They don't give the guidance.
Yeah, formally. But they talk to the analysts, and there's a reason all the numbers came down for the June quarter. So, but the analysts keep recommending it because the stocks sort of worked, and the multiple keeps going higher, even though the thesis of services is going to accelerate isn't working. And it may be the come to Jesus moment is the third and fourth quarter of this year during the holidays or back to school season. We'll find out. But, saying, okay, we're going to go into India and pick up, customers there. Well, it's a lot lower priced market in India. People aren't as rich. So it's going to be a lot tougher to sell $1,000 iPhone. And granted, they're attacking that market with low end, it's more the lower end stuff. But this is just going to become a little bit more challenging. It was already challenging before COVID. We got way more smartphones on the market today than we had in 2019. So we'll see what happens. I don't spend a lot of time on Apple because I'm not worried about managing to some benchmark. Well, actually, I shouldn't say that. I do spend a lot of time on Apple, but for me, it's, I'm long it sometimes, I'm short it sometimes. We'll see what, excuse me, and I don't have and in full disclosure, I don't have a position in it right now, but I'm definitely, as you can tell, more prone to want to short this.
Yeah, I'm
definitely.
in the same camp. Given that you don't have the short interest risk as well, nobody's going to buy it. So it's a very cheap short from an implied volatility perspective at local highs.
Yep.
Awesome. I want to make sure we get Jaguar in here with a question as well before we end it up.
Wait a minute. Why can't I get a cool name like Jaguar? That sounds great. Sounds way better than
listen,
Dan.
It is a good name. Jaguar, you got to come out here with a big roar or something.
Dan, on the internet, you can be whoever you want, Dan. I'm stocks on Spaces.
Ah,
Go for it.
Okay. Sounds good.
Hi, guys. Hi, Dan. I've been following you for years. High respect for your market views. I will never forget that moment, actually, when I was watching CNBC. I believe it was in 2015. And I saw you present the bull case for AMD when stock was trading at $4 per share. And you saw the secular long shift in the market share in favor of AMD long before anyone else did. And I watched it, and then I saved the recording of the video. I'm sure I have it somewhere, and I watched it again. I'm like, there's something here, something different I've never heard before. So what a great call that was. Actually, and I know that you are more tech focused, but as I have been following you for a long time, I think you see opportunities in many different ways in the market, not just in tech. So I wanted to ask you a more broad question about the overall market.
Mm-hmm.
Just like you, I've always managed dual portfolio of long and shorts.
Mm-hmm.
And when we look at bonds today, the 3-month Treasury bill is paying 5.2%. The 2-year Treasury is yielding 3.9%. When we compare that to the S&P using $221 per share in the earnings assumption, which are trending lower, the index is trading at 19x forward earnings. That is an earnings yield of 5.2%, which is the same as 3-month T-bill today. And it's only 140 basis points above the 2-year. With equity risk premium being so low, do you believe the multiple in SPX is justified here? And if the answer is no, do you see an asymmetric opportunity to just be long bonds, especially in a situation if we have recession risk unfolding in front of us?
Yeah, you pretty much laid out the case, and I've talked about this before. Actually, coming into this year, one of my top 5 picks was cash and 3-month T-bills. So 100% agree for all the reasons you brought up. I can get a guaranteed return of 5%. Why on earth would I want to be in the S&P? And it's funny because I had my godson, and I think I tweeted about this a long time ago. Who's a rapper. He, texted me this morning, and he was like, "Hey, Uncle Dan, what do you think of this? I can put my money in a overnight money market fund that yields me 4.5%." I was like, "It's a great choice for you, Golden. You should definitely do that." And so you've got people in general and gold's 22 years old, and you've got people in general, and I think to some degree the banking crisis has had people actually look at what they were getting on their savings account, checking accounts, and go, why the heck am I getting paid 35 basis points, which I think is the average, when I could be getting 5% on a 3-month T-bill? So this is also part of the reason why I think we have a problem. And to your point on valuations, and I said this earlier, and that chart that Evan tweeted out, that link to my website, it shows, at least for this year, and if you go back further on danniles.com, you'll see a chart I have in there of the 1970s and that whole decade, and you can see how when inflation, and I've done this analysis for 70 years, but when CPI is above 3%, and obviously today it's closer to 5 than 3, and granted it's down from 9, right? So that's really good. But when CPI is above 3, the S&P trailing P is 15 times, and as you rightly pointed out, Jaguar, it's 19 today. So the risk reward is poor. Doesn't mean that market can't keep going up. I saw that in 2000 where valuations got a heck of a lot higher than I ever imagined possible. But I think we're on the other side of this, and the risk is to the downside. And we've just had another bear market rally. And to your point, there's a great alternative, and that's called a risk-free T-bill.
Yeah, exactly. So each 1x change in the multiple is 220 points in the S&P. Just to return to 15x based on your own analysis, that's almost 900 points in the S&P.
Yeah, the S&P's got to go down 25%.
Right. Which may very well happen if the recession risk clearly unfolds in front of us. But here is just to play devil's advocate, because I'm questioning even my own inner thinkings and work around this.
The market doesn't make you do that. You're not very smart.
I like to challenge my own thinking where I could be wrong, and that's how I try to form an opinion. You do the same thing, right?
Yep, so absolutely.
Have we gradually in the market? Have we gradually trended in the direction in which we are constantly establishing a higher and higher floor for the market multiple, where the norms of the past, which was 12x, 13x on the recessionary scenario, or normalized market 15, 16x, the floor continues to be raised to the point where the new normal is now 18 or 19x? I mean, or this is just a short-term phenomena? I mean, in an era, since great financial crisis, when we replace the interest rate cycle with quantitative easing programs, for example, right?
Yep.
Are we permanently ever establishing a higher and higher floor on the multiples?
So one thing I would point you to, and whoever's listening, if they have the time, is if you go back to an article I wrote on 3/27/23, so March 27th, 23, there's a slide deck there. And if you click on slide 18 of that slide deck, and I'll just put it into words, it shows the decade of the 1970s. And for those people who don't remember, the 1960s was a period of very low inflation. So multiples over that decade just continued to climb and climb and climb. And they got to about 20 times trailing at the end in the early 1971 time period. And then inflation started to take off. And the multiple, it seesawed back and forth, but it got down to about 7 times. But it took a while. And so I don't think that this is how you start off the conversation was great, which is you pointed out what you can get on a T-bill. And so you should get compensated for the risk you're taking. If you're not getting compensated for the risk you're taking, I make this analogy of you got to separate a decision from an outcome. And I think if I toss a gold coin into the bottom of a pool and that coin's worth $1 million and it's full of man-eating sharks, and you dive in, you get the coin, you get out, and you're fine, you don't have a scratch on you, that's a great outcome. Doesn't mean it was a good decision. It was a horrible decision, but you got a good outcome. And that's the way I view investing at the market right now with the multiples as high as they are, because I don't think that this is structurally any different, because I think inflation is structurally going to be a much bigger problem, because you have population declines in China, you've got onshoring, which is way more expensive, and ESG policies are fantastic for the environment, but it's tough on inflation because commodity prices structurally will be higher if you can't expand. For all of those reasons, I don't think that we're at a permanently higher period of time for the multiple. What I think though is it's going to take some time, much like it took 2.5 years following a decade-long expansion in 2000 for us to find the floor in October of 2002. I just think this could be, unfortunately, this grinding up and down market for, through the end of this year at least. And I think also the other part of it, which wasn't asked, is right now the market is forecasting the Fed cuts 2 times this year. And I think when it becomes increasingly clear that inflation is going to come down, but it's not going to get to 2%, so the Fed's not going to be able to cut, which is what everybody's praying for who's long, I think that's also going to force the market multiples lower because inflation's staying structurally higher. And the piece of this that we haven't talked about is there's still 60% more jobs out there than people unemployed. That's going to keep wage inflation high. And services, excluding housing, is still 55% of core CPE. And when you've got that many more jobs than people unemployed, the only way the Fed's going to cut is if the economy gets so bad that you lay off so many people that services inflation through wages gets under control. And either way, you've got a problem with the multiples in the market, because if earnings, by the way, and you said it rightly, right? They're around 220 today. They were peaked at about 252 last year in June. I think during a normal recession, earnings normally come down 20% from their high. So 252 down 20% gets you to about 200. We're at 221 or so, 220 right now. That's still a fair bit lower that earnings can go, and your multiples are high off of inflated earnings. We'll see where that takes us.
I just want to jump in here really quickly. I want to make sure we're being respectful of your time, Dan. We did ask for an hour, and we are over that.
Oh,
we're good.
Yeah, I didn't even notice that.
Going. It's been a great conversation. That's generally a good sign.
Well, why don't I give you one last question, Evan, and then we'll call it a day, because I do have to get to other stuff.
Perfect. I do just want to mention that graph that you were talking about, I did pin it up in the nest above, chart 18 from March. So you can go and check that out. And I think I would love to throw the last question and give that over to Stock Talk, our co-host up here.
Yeah, Dan, I think, to wrap it up, I think a great thing would be to just get your general view, broadly speaking, on the second half of the year and where you see equities at. I know late into last year you were talking about a potential that you saw for the S&P 500 to revisit 3,000. Do you still have a bottom line bearish view that's that low? Has it gone up at all? What's your view on the general banking crisis? I guess just some broader comments to close here so people can get a better idea of where you stand into the second half of the year.
Sure. So what I would say is the downside risk, I still believe, is 3,000 for a simple reason of, if I say, well, earnings were at 252 at their peak. During a normal recession, they go down 20%. That gets you to 200 in EPS roughly. And then if you assume that CPI gets down to 3%, and then you take the average multiple over the last 70 years when CPI is above 3, and you say that's 15 times, that gets you to 3,000. So that to me is the downside risk, which obviously is way different than where the S&P is today at 4,130. And that sets up the risk reward for me. Whether we get there or not, we'll have to see. But to me, that's what makes, when I have the alternative, putting it into something risk-free that returns me 5% for the next year, that looks pretty darn compelling to me. So the second half of the year, to your point, I see multiple things happening from a fundamental basis. First, is that all the bank failures that we've seen so far, and by the way, the big banks are going to get assessed to cover the bankruptcies of First Republic and Silicon Valley Bank, etc., Signature Bank, and anybody else that might be coming. Obviously, there's a lot of concerns around a couple of other smaller banks. That's just going to tighten the access to money between now and year end. It's already tightened. And as we talked about with commercial real estate, that's going to be a big problem as all of those companies have to refinance. And there's, hundreds of billions of dollars worth of debt that needs to be refinanced. So to me, and then I see results like what Disney put up, and Disney's a good company, I think we can agree. And I go, the advertising markets was really bad. And advertising tends to get really bad as you're going into a recession. So from all of those points, that's why, I'll be the first to admit it. I've been stunned that stocks have held in as well as they have over this last period of time. But having said that, if you go back and look at history, you have these rallies. They happen all the time. We talked about the global financial crisis. We talked about the tech bubble, and you can have these 20% rallies in the S&P, and they've happened in history. And so my general touchstone that I invest to is if the fundamentals are keep on getting worse, don't try to be a hero and somehow think you're bright enough to pick the bottom. And right now, fundamentals are continuing to get worse. And so for me, okay, maybe multiples keep going up and estimates keep going down and you luck out and you do well anyway. But I don't want to count on getting lucky to make money. And if estimates keep going lower, I want to stay the heck out of getting my head chopped off with valuations as high as they are. And that's why we have as many shorts as we have longs at this point. And so, and we manage this daily. I don't put out a tweet every day because, I don't feel the need to. But, I look at data every day. And today I spent a lot of time thinking about Disney and, talking about parks not being quite as good, talking about, losing subscribers, talking about their linear TV advertising, how horrible that was, which was really a surprise. I knew it would be bad, but I didn't think it would be that bad. And then thinking about what a great company Disney is and going, all right, it's kind of confirms my thoughts because they're a global company. And, the comments around China, at some point this will hit bottom. But it can take you some time, and I don't think investors have fully discounted that because over the past, since, 13 years or so, every time things have weakened, the Fed's been able to step in and stimulate. And unless inflation is going to be a lot lower than we think it is, and I think the only way that happens is the economy is a lot worse, this is a tough, you're going to have to thread the needle, I think, to assume the market's up between now and year end, and I don't. So I think with that, depressing note, but the good news is I think the positive is once we get through this, just like we got through 2000 to 2002, just like we got through 08, there's going to be some unbelievable investment opportunities on the other side of it. And I think one of the earlier questioners that said, yeah, we got some stocks trading at cash value. And so, in the smaller cap spectrum, there are opportunities starting to assert themselves. I mean, I bought Amazon. Like, I haven't been bullish on Amazon's retail business in a long time. But in a recession, could they take share? Maybe. Like at this valuation, yeah, maybe. And I can hedge it with something else. And so I think there are some opportunities, but from an overall market perspective, yeah, I'm pretty bearish between now and year end, given that fundamentals still seem like they're getting worse. And that's what I just come back to.